Hello everyone, welcome back to my channel. So this video marks the end of the week number 64 in this road to 100k realized return challenge. And this was a very volatile week. This was one hell of a week, I should say. There's a lot of to unpack here, and let's start first and foremost by the recent developments or the developments that took place throughout the week. Basically, the week started the first few days by a de-escalation of the trade tensions between the U.S. and China, and so those talks or the tone the toning down of the stance between the United States and China appeared to have had a positive effect on the markets, and that is mirrored here by the what happened basically here in the first few days of the week. This is the chart of the IWM, so the index that follows the Russell 2000, and things appear to be going okay. Also, because throughout the week there was a heavy dose of earnings announcements by financial companies, which were quite okay in the beginning, and overall the bank's performance in terms of business was very good. If my memory serves me right, almost 90% of the financial companies that reported beat their earnings estimates by analysts, so it was overall very good. However, towards the end of the week, some warning signs started to pop out, because by the way, before this, also another positive factor that went on throughout the week was the fact that the Fed Chairman Powell also signaled further rate cuts amid a weakening job market, and this is also remarkable given the fact that we are still in a government shutdown, and so there is no additional information coming in from the government in terms of economic data, and these were pretty much the positive points to take away from this week. However, as we went towards the end of the week, some warning signs started to creep in. Specifically, the fact that there are some banks that probably overextended a bit their lending, and there are some increased default risks, especially in two small banks, and this caused in investors a lot of concern, given the fact that about 2.5 years ago we have the Silicon Valley Bank in early 2023, which went belly up, actually, and this brought some ghosts from back in those days, and also the fact that there is also some tensions about how this situation is going to come about, whether these risks may escalate to other sectors of the economy or not, and so this is pretty much the way things went throughout the week. Now, and the market, with this, bearing this in mind, the market, I would say, pretty much went against us on almost every day. And why is that? Because, as you can see, and if we zoom in on basically what happened throughout the week, not so much on Monday. On Monday there was a positive gap here, and this was also documented in the previous video. But here, as you can see, there was a U-turn on pretty much every market, every trading day. Here the markets gapped down, and this was something that, when this happens and the market begins to trade down pre-market, and then when the market opens, you have these large gap downs. You expect that things will continue to go downhill pretty much the rest of the trading day, or throughout the trading day. However, on Tuesday, this was anything but. The market went very strongly up, and because of that, we left a lot of money on the table. Perhaps it's better to explain this in the context of our trades. Just to give you a brief explanation of what happened here and looking at our profits for the week. Let's just take this value out of the way. And so this week, we managed to accrue almost $1,150, so $1,148 for the week, which was of course lower than it could have been, especially given these U-turns that the market made, and this caused us to leave a lot of money on the table. But we started the week with 1,200 shares of IWM here, as you can see, and this option ended the day on Monday. These covered calls expired worthless. All right, so there was nothing to do. The price 245 was not achieved, and so they expired. However, the next day we still did the same trade at 245 with a 245 strike price in order to break even, because with this large gap down, all right, from about 244 to around 241, we expected, all right, this will continue to go down, and we could have made the rollover at the end of the day here on Monday to the calls expiring on Tuesday, but basically we expected, all right, the market will probably recover and continue to go up in pre-market trading the next day, and will open higher, and so we are going to wait and see what happens. However, we expected that in between the days the market would continue to go higher, and that's why we didn't roll over the calls here at this point late on Monday, and so the market went the other way. It went down, and hence it had its gap. And so when we sold the calls in here, we had the expectation, all right, this will continue to go down, and so we sold the calls at a very discounted price. And of course, because the market had already quite some distance to our cost basis, we sold the options at a break-even strike price at 245, and we only received 11 cents for it. However, as you can see here, the market went on a rally basically, and it ended the day, at some point it went almost up to 249 and a half, and at this point I was already wondering, my gosh, we left so much money on the table. This was almost $5,000 that we could have gotten, or almost $5,000 that we left on the table, that we didn't accrue any of it. Still, the market went down at the end of the day to around 247. So basically, it meant that we left around $2,400 left on the table. So yeah, still, it was an amount that some we could have gotten if the market did not have this U-turn right at the beginning of the session, which of course we cannot predict. But since then, of course, our calls were definitely assigned. We collected $602.90 on this wheel, right? And then the next day, with our money released, we went ahead and we sold 12 puts with a strike price of 248. Still, you can tell that you notice that we had to elevate a lot our strike price. And why is that? Because again, the market opened with a gap up, all right, and so we expected, all right, this is going to be a day in which probably the market will go up, and so we have no other option but to set our strike price higher. Still, this was not the case, and the market, after a brief run up, which took about 40 minutes, the market went down and remained somewhat subdued until the end of the session. Still, at some point, as you can see, we finished. These puts were in the money because the stock came down to 247 and 70, but at the end, before the end of the day, it recovered. And because of this, it was my decision on the next day, on Thursday, to go a bit more conservatively. And by the way, before the end of the trade of the day on Wednesday, we still managed to roll over. We bought back with these puts and sold some puts on the Qs, just in the dying sections of the trading day. We still collected almost $36. So this was just a very, very low risk trade that we were able to do. But on the next day, on Thursday, I decided it's better to go a bit more conservatively this time, given this pattern that the market did. The market tested a bit this area over here, and we'll test it again on Thursday. Of course, we had no idea what was going to come, but still, we decided to go for a bit of a lower strike, and at the expense of getting a lower premium, but we still went for, as you can see here, a 10 delta put, which of course, being a delta 10 put, it has a 90% probability of expiring worthless. But of course, as you can see, this day was a bloodbath. I think this is the best way to put it, because even though the market opened gapped as a slight gap up, until the end of the day it went pretty much downhill, and we still use the same strike price here, as you can see, at 248. However, the price went down to around 244, 245, 244.80, 249, 245, and so our 248 puts, of course, were assigned as they as they inevitably ended up being. And this was, of course, because of those concerns that I mentioned about the small banks that probably overextended their lending. And yeah, basically this is what we had to do. And now that we had again another 1,200 shares at a cost basis of 248, we had no other way but to sell calls at 248 strike price, because the price was very much below the strike. We had to settle for a small premium, just 11 cents, and still the market continued to come down and somewhat recovered, and then down again. But still, all this volatility was nothing that could really help us, because we really needed to recover. And because at this point, at around this time of the day, the calls that we sold were worthless. I decided, all right, the stock will not definitely not return to anywhere close to 248, so let's just roll over to the options, to the calls expiring next Monday, so next week. That's why we have this data missing, all right, because these are options that will expire only on next Monday. And so we managed to get a slightly higher premium, and by doing this trade, I'm expecting that the market will not recover on Monday. This can always happen, of course, but one thing is for sure: if we don't make this trade, we don't make this rollover on Friday. This option, this call option with a strike price to 48 expiring on Monday, will lose some time value. This is always certain. And so I decided, all right, we are going to make the trade, and if we leave some money on the table, so be it. Because we at this point in time we don't know what the market is going to do on Monday. These things tend to get forgotten by the investors rather quickly, and markets tend to recover in just a few days. But still, this is a decision that is as valid as any other. The market went pretty much against us throughout the week. If we had made the opposite decisions, things would have gone better. But again, this is a decision that you have to make at that point in time, and yeah, and you have to make it completely in the dark without knowing what's going to happen in the future. So this decision was made, and so now we have to see what happens on Monday and see if the market recovers or not. But this was pretty much what happened for IWM. For XLF, if you recall, we still had 100 shares, which we bought here at the previous week at the strike price of 53.50. And when it comes to the XLF, here is volatility for you, basically, because this is the 1 week chart of XLF. For such a low volatile ETF, this was anything but a quiet week. So of course, because of the earnings announcements that took place, again, if you recall at the last video, we sold 2 puts at 52 strike price, which are here. Where is it? So XLF, yeah, it's here. So we basically sold 2 puts. Why is that? Because if these puts were assigned, our cost basis would come down to 52.50 instead of the current 53.50. However, given the situation that we mentioned, the market of course went up, and I was hopeful that the puts would expire worthless before the end of the week, and as you can see here, the market peaked on Wednesday at around 53.70, and so I was already in the hopes that, all right, if we keep this level, our calls will be assigned, and we will be able to sell our 100 shares of XLF. However, yeah, my hopes were dashed very quickly, because given the news that surfaced, the market, or the stocks that compose the XLF, the financial companies that are in the XLF ATF, pretty much went downhill for the remainder of the week, all the way until Thursday night. And here at this price level, not only our calls, our call was basically worthless, and that is the reason why we rolled over, and it's somewhere around here. Yeah, it's here. We rolled over the calls that we sold on Monday. We bought back the one we had, and we sold another one expiring for next week, and that's why you have here also another piece of information missing, because this call will expire only on Friday in the next week here. And so not only our call was basically worthless, but our puts were also in the money, and so there was a very real possibility right here that our puts will be assigned. However, and I was already expecting that when the session finished on Thursday. However, on Friday, the market ended up recovering, and it never came back to the around the 53s, but it stayed high enough so that the puts that we had sold basically expired worthless, which are right here. And so, given this situation, this was, of course, a very, very, very volatile week. This was an absolutely crazy week. Still, things to do next week. Of course, we will continue to try our best to sell these IWM shares at 248. It's not going to be easy. I expect that it won't be easy. The market won't return that quickly to the 248. So we're gonna have to continue to sell calls on this. About the XLF, given the low volatility of the index, of the ATF, and given the distance that we currently stand from 5350, all right, I am expecting that we will continue to hold these shares for the remainder of this week, and by the next weekend we will still continue to hold the shares, because I don't see the price escalating to 53.5 now that most of the volatility events were already behind us, and so there is no volatility forthcoming, at least in terms of earnings. The only thing that can come up is the Fed meeting, the upcoming Fed meeting, that can spike a bit volatility, but I don't see making enough of an increase in volatility that will cause the SLF to get back to 53.50. And so, given the situation, probably our best course of action is to use the buying power that we have, which is a little bit over 10,000 euros at this point, to sell 2 additional puts on XLF. But this time around, probably we will settle for not the 52 strike price, but the 51 and a half. And this will continue to bring our price down. Our cost base is lower if these puts are assigned, and if we manage then to sell calls at 52.50, we'll still pocket a slight capital gain, because with 100 shares bought at 53.50 and 200 shares bought at 51.50, the average cost basis will be below 52.50. And so if we sell the subsequent 300 shares at 52.50, we will still be able to pocket a small capital gain. And yeah, this is what we have on the menu for next week. Most likely we don't have enough money to sell more puts again on IWM or the Qs, so we are pretty much hoping to sell these shares through selling calls. So yeah, that's basically it. And I think that next week is going to be the next Fed meeting. I am not sure. I have to see on the calendar. But that is my expectation. Let's see. No, it's only on October 28th and 29th. So it's not going to be this week. It's going to be on the week after that. And so next week will probably be a bit quieter, apart from a few more earnings releases for the third quarter. But yeah, the big one will be the Fed meeting, in the last week of the month. And yeah, so far this is pretty much it. Let's put back this value here, because this is a mark-to-market value. It's not relevant even anymore, because the price is below, the current market price is below this. This is just an indication that we have this an unrealized loss here that we need to compensate when we sell back the shares. And yeah, for the time being, this is all. Feel free to leave your comments in the comment section down below. Also, I'm available on LinkedIn in case you need to ask me any questions. And of course, feel free to like the video and subscribe to the channel. And we'll reconvene either on Monday evening or on Tuesday morning to start the week number 65 in this challenge. And yeah, I'll see you there.